look at the fixed income space. As promised, Kieran Quain's with us from Fixed Securities in studio today as well. Kieran, thanks for your time. We've got the RBA board meeting coming up. It's our sport in Australia to decide, to speculate ahead of that what they're going to do. But what about some of the bond yields, both short and longer term? What are they saying and what have they been doing in the last week?
I guess all the move happened in the weeks prior. Speculation excuse me, speculation on the upside in yields occurred prior to this week, and they've been pretty stable. 10 years at about 5.1 and 3 years about 4.85, and they've just rallied marginally and just been stable.
Because, you know, the money market move and the pricing in of an October hike has been so rapid now in the way it's grown, and people now saying there will be a smoking, the dollar will be smoked. You know, it'll be completely decimated if those expectations aren't met. What will the bond market do by comparison come Tuesday if there is no tightening?
If there is no tightening, well,
because what message is that telling the bond market about the broader economy? Put it that way.
Well, it depends what the speech from the governor or what the RBA says in conjunction with the release about and statement about monetary policy exactly. I suspect that projections will be for the move to be in November if it doesn't happen in October, and the bond market itself hasn't necessarily priced in a dramatic amount of monetary policy moves, 1 to 2 at the moment. The yield curve's quite flat with a 10-year rate at 5.10%. A lack of a move won't necessarily damage it too far. It'll just push it out slightly.
Yeah, and the interesting thing was overnight, you know, the IMF, quite a rosy forecast on growth as well. What, 3 to 3.5%, which is where we'd be wanting to be sitting. So that would imply, as you say, what, the market doesn't believe more stimulus, for instance, would be needed, if that's just going to happen of it in itself.
Exactly, and the RBA governor's pretty well said that in that regard. He said that the economy's growing above trend, and there is capacity constraints in there, so yes, doesn't need more stimulus, definitely. And
you mentioned that flattening of the yield curve. What is that saying about, I guess, how comfortable people are about the inflation picture? And how the RBA is dealing with it?
Yeah, it's implying investor confidence in the RBA going forward for the long term. It's implying that maybe the cash rate move or monetary policy tightenings in the order of 1 to 2 might be capped there. Looking forward, prepared to invest at just above the forward expectations of the cash move. So the currently cash is at 4.5. If it moves to 5%, you're buying 10-year bonds at 5.1%. It implies a lot of comfort about the RBA containing that inflation over the long term.
It's very interesting you say that, because, you know, you also concede, as we well know, that we're so highly geared into property now, and yet the Reserve feels that despite those high gearing levels, with banks and 60% of their loan book into that space, that more rate rises won't actually cause pain, won't unsettle the economy?
They'll cause a little bit of pain. I mean, it's quite obvious that demand would, I think it's obvious that demand would slide because the economy is, or demand for capital, borrowing more capital would slide going forward if there was a dramatic amount of monetary policy increases. So the market's very sensitive to rate rises.
This chart looks like one of those 1980s games that you used to play. You used to stack blocks one on top of the other, doesn't it? And you're just beginning to build a base there. Exactly, Brooke. Thank you. So what is that telling us?
I think that refers to a period in late 2006 where the curve last inverted, the yield curve last inverted of some consequence following 6 monetary policy moves since 2002 to 2006. I think from 4.25 was the base rate in 2002 up to mid-2006. The curve finally inverted with the 10 years holding at about 5.8% for a period of 6 months. Just implies that eventually the moves are significant enough, and investors will buy long-dated bonds at levels where they believe they'll hold for long term.
And again, yeah, and what's going to hold them at those levels?
Well, the implication is that the demand will slow as a result of further monetary policy tightens of any magnitude, and we're getting close to the end of that sort of cycle.
Because now the debate is, and it's kind of academic, isn't it, will there be, if there are going to be 3, And that will be when the yield curve makes that settled run, as you just saw there, on a par with that 6-month trend that you were just pointing out. Could that potentially be about to happen, what, as of, say, May next year?
Oh yeah, over the next 6 months it's very conceivable that 1 to 2 monetary policy moves and the yield curve could invert, yes. Yeah, and given current statistics and obviously the focus on the heavily geared nature of the Australian residential sector especially, that might be the catalyst.
And do investors then show a greater appetite for the corporate bond market where that spread can be a whole lot more appetising? You know, is that going to be perhaps a trigger point?
It won't be a trigger point for the Commonwealth curve inversion, but definitely a high yield focus where the base levels are perceived capped for a long period of time, and there's confidence in the RBA going forward of containing inflation and economic constraints. Yes, corporate yields, especially in this environment with low supply, corporate yields could contract.
And just in terms of the overall outlook, then key indicators that you're watching for from this point forward, what are they?
Oh, no doubt it's unemployment. Unemployment's the key in all economies at the moment. In Australia it's 5% and improving, and that is possibly the reason, or that is the reason why we can have a highly geared economy, I suppose. But in the US it's 10% and stagnant.
Good stuff. Thank you so much, Kieran. Great to get you on board. Thank you. And Carson in studios.